the real problem with the poor results we are seeing from financial services companies. The stock price of L&T Finance fell to a 4-month low after HSBC Global Research cut its target price on the stock. The decision given a likely disruption in assets under management and earnings per share growth in the near term because of sectoral headwinds in microfinance, which of course is a sub-segment or a segment of finance. But L&T Finance is not alone. India's Bajaj Finance reported lower than expected second quarter profits last week as it set aside more funds for potential bad loans. The company reported a consolidated profit after tax of about 4,000 crores in the 3 months to September 30th, 2024. Now, analysts on an average had expected about 4,300 crores or a little above, as per estimates compiled by LSEG and Reuters. Now, that non-bank finance company has been grappling with elevated losses in the last few quarters, especially in the personal loan segment in rural regions, according to Reuters, which also added that it had reported lower than expected profits in the first quarter as well, thanks to higher funds set aside to cover potential bad loans. Earlier, Kotak Mahindra Bank and RBL Bank reported a jump in bad loans that hurt their second quarter profits and margins, a trend that could well continue. Kotak's slippages, or the proportion of good loans turning bad, has jumped close to 40% on quarter for the July to September period. Meanwhile, RBL slippages were about 1,000 crore rupees, that's doubling from a year ago and up nearly 43% from the prior quarter, according to Reuters. Now, several NBFCs have already been asked to stop lending, including the most recent Reserve Bank of India crackdown on several of them, or at least 4 of them, of which 2 are well-known app-based ones, for, among other things, usurious lending or unlawful interest rates, coupled with, of course, poor due diligence. Now, it is no secret that the Reserve Bank of India has been consistently warning about excessive lending in unsecured and small loans. The more aggregate data in terms of impact on banks and non-bank finance companies will emerge in coming days and weeks. But it is clear that there was froth at the top when it comes to consumption and demand, whether for products or for services, or driving speculative activity in the stock markets. And this froth has been driven by borrowing, or a lot of it at least, and not real income. Now, the extent of this may be limited and might not cause systemic damage, as we call it, because the controls at the top are fairly strong, and the Reserve Bank of India has been steadily tightening norms, including asking for more risk weights on the lenders' balance sheets, as it did in November last year or 2023. But the unwinding can be painful, mostly for those people who've borrowed and recklessly consumed, or for that matter, invested in speculative assets. So the stock markets could slip further and more small loans could go bad. Now, this would raise some questions on the nature and quality of that increased consumption that happened in the first place. A good part of the post-COVID spike in spending was driven by borrowings, or at least to a good extent. Now, that is not so much the problem as the resultant interpretations on the quality of that spending and the resultant consumer spend data. So, if you know what I mean, all the data that we've been seeing about the increased spends in consumption in terms of consumer products and services could have been, or was definitely partly driven by borrowing, which of course is not a very healthy thing. It would appear that companies have over-interpreted consumer spending behavior and are now sounding somewhat surprised that it's all moderating. So there is that sinking feeling, which will stay till we are able to see the full picture on what really happened in the last 3 years, particularly on the balance sheets of non-bank finance companies, or for that matter, even banks. And worse, the individual balance sheets, which we will never, perhaps ever see.